Hey, what's happening, guys? Coach Carroll here. Wanted to do a little video, something a little out of the sales arena. I know a lot of people are getting ready to pay their taxes. If you're in business, this isn't a good time for you. There's two types of people. One person looks forward to tax day, the other one dreads it. So if you're an entrepreneur, small business owner, you're dreading April 15th. So I want to tell you something that I saw a lot of people talking about here recently in some of the forums that I'm featured on, and it was the deductions and how they deduct things. And I saw a lot of stuff about daily expenses that a lot of you know about already, you know, fuel and materials and labor and what have you, meals and entertainment. But one of the most undervalued or unknown, one of the most unknown deductions, and again, in full disclosure, I'm not a CPA, so please consult a CPA or tax attorney before doing anything, but check into the 179 deduction. 179 deduction. It allows you to depreciate assets fully up in 1 year, and I believe it's like up to $250,000, depending on, you know, what state you're in and whatnot. I'm not sure how those regulations affect you. That's why I say make sure you guys have a CPA. A CPA and a good attorney are your best friends when it comes to running a small business. So make sure you guys check in with your attorney. But in essence, what a 179 deduction allows you to do is it allows you to buy a truck or a power washer or a skid steer or what have you. You know, something like that. Maybe a salt spreader or the power washer there. I'm at Easy Pro right now, about to go do a couple estimates. But a 179 deduction, in essence, allows you to buy that, or that, and write it off completely in the first year. Now you might be asking yourself, what's the tax benefit, DJ? Why do I need to know about a 179 deduction? A 179 deduction, taking the full amount, allows you to depreciate down your net income or your taxable income with the full amount of whatever it is you spent. See, this is where a lot of guys get in trouble. So let me explain how this works most of the time when guys get in deep water. Say you made $15,000 net profit this year, and you took $10,000 of that and you went out and you bought a truck, and you say, I'm going to depreciate this $10,000 truck over 5 years because that's how long I plan on keeping it. What happens is if you depreciate that out over 5 years and you take $2,000 per year, that means that your net operating income, which was $15,000, stay with me here, $15,000, you depreciate $2,000 off of that. That means you still have a taxable income of $13,000. Now, without having a calculator handy, you've wiped out $10,000 of your cash, which means you have $5,000 left over to pay your taxes. What happens is if you spend too much of that money, right? So if you spend too much of that and you don't take the full depreciation, say you had $20,000 and you went out and say, for lack of better terms, we're going to tax you at 20%. So that'd be $2,000 on every $10,000 of income. So that means on a $20,000 net income, stay with me here, $20,000 net income, you're going to have a $4,000 tax bill, okay? Now, again, these are arbitrary numbers, but on a $20,000 income, you've got a $4,000 tax bill. Now, if you went out and you spent $18,000 of that $20,000, and you're going to amortize that, or I'm sorry, if you're going to depreciate that over 5 years or 10 years or whatever may have you, you're only going to lower your taxable income a little bit, and you actually might not have enough cash to pay your tax bill. Now, this becomes a problem, okay? This becomes a huge problem whenever the tax man comes knocking at your door on April 15th and says, DJ, I need you to pay your tax bill. And you go, man, how can I owe all this money when I don't have that much money in the bank? So then what happens is you wind up going and borrowing money, or you start stealing from the next year to pay your tax bill. So guys, please go out there. You know, today is March 14th, so it's about a month out from tax day. Make sure you consult with a CPA or a financial consultant of some type that has tax knowledge, that knows exactly what you need to do. And there's two types of people out there, okay? There's the accountant or the bookkeeper, and then there's the tax advisor, okay? So a lot of times they don't particularly do the same thing. Here at Easy Pro, we actually do all of our books in-house by my office manager, but then I meet with Troy, my CPA. And if you guys are in the Louisville, Kentucky area, check out Kelly King and Company. They're in Crestwood. Does a great job, phenomenal job. Troy is a down-to-earth guy, easy to get along with, and knows his stuff. So $179 deduction. Go out there, do a little more research, and when you're getting your taxes put together this year and going forward, make sure to keep that in your playbook so that you guys can lower that taxable income and keep some of that hard money that you work so hard for all season long. Take care, guys. Make sure to check out on the main page the webinar, the free webinar on cold calling, coachcarroll.com/cold. And make sure you follow me on all social media, #Coach Carroll. Here's to your success.